A very warm welcome to everyone. My name is Greg Dart. I'm a member of the Executive Board of Directors here at High Street Auction Company, currently operating in capacity as Operations Director. As a precursor to my presentation this morning, I just want to note how proud I am of High Street's performance as a leading auction house. Having already completed over 200 multi-prop auctions, presented well in excess of 5,000 properties to the market, and created many billions of rand in value for our clients. Whilst we have achieved some exceptional results in other asset classes, including movables such as collectors' cars, High Street's focus remains steadfastly on real estate as an essential asset class in a well-balanced investment portfolio. High Street's focus on real estate is well motivated. A recent report by Savills shows that global real estate value at the end of 2022 was at about $380 trillion. This asset class saw a significant growth of almost 18.7% over the last 3 years, demonstrating once again that this asset class is a significant store of wealth. It's amazing how much value is locked in real estate. It's worth more than global equity and bond markets combined. It is a further fascinating fact that the value of all gold ever mined, about $12.2 trillion, only represents about 3% of the value of global real estate. The report noted that almost 3/4 of this global real estate is locked up in residential stock, representing a cumulative value of almost $287 trillion as at the end of 2022. Commercial property, which is where High Street has a particular focus and an amazing showcase of work, on a global perspective represents about 13% of the global real estate market, or almost $50 trillion. Agricultural land at about 11% represents the balance. My good friend, Professor Adrian Saville, currently the Professor of Economics, Finance and Strategy at the Gordon Institute of Business Science, has consistently made a compelling investment case for real estate at various High Street auction events as a guest speaker. He highlights that over the past 20 years, real estate has delivered some of the best returns in the United States, the world's largest economy. In the United States, REITs have generated an impressive 11.2% per annum return, compared to the 9.5% per annum return from listed equity, as measured by the SAP 500 index. Whilst the United States is a useful reference, let's shift our eyes back to South Africa. Our real estate investment case is particularly attractive due to the low economic growth rates that have depressed property prices. It offers an excellent entry point. I think without a doubt, the strong business narrative for this investment case is further enhanced by the outcome of the national election and the appointment of the government of national unity. We've also seen significant progress in the energy sector, rolling load shedding seemingly a thing of the past. We've seen moderating consumer price inflation, which is great news for the consumer and affordability. And of course, the anticipated interest rate cuts in September and November herald hopefully better affordability and spending. Talking again to the narrative that real estate should factor into your investment planning, Lightstone reports that just over 16,000 transactions were concluded on commercial property in 2023 for a cumulative value of $54 billion. This despite challenging market conditions. Having provided some headlines on real estate as a desirable asset class and an essential part of your investment portfolio, I'm very excited about the prospects for the company and for the country moving forward. The outlook is positive. I remain very confident about High Street's ability to provide a premier marketplace for buyers and sellers of desirable real estate, allowing our clients to optimize their investment strategy in this essential asset class. Thank you.
G'day folks, Sean van Jaarsveld here from the High Street Auction Company in the Western Cape, and really the trophy province of the country if you want to, with the numbers and the data reflecting continued growth. So what's happening by the numbers? Interestingly enough, if we take a look at the Lightstone 2023 end of year results, it shows a very interesting picture for us. KwaZulu-Natal had just over 1,000 households purchase residential properties. Johannesburg with just under 2,000 at 1,971. But very interestingly, the Western Cape, Cape Town, sitting with almost 6,500 households who purchased in 2023. And that really is a testament to why I'm getting so many phone calls on a daily basis. You know, I get phone calls from my team, I get phone calls from investors, from Johannesburg, from Natal, everyone looking for these opportunities in the Western Cape. The semigration trend is not going to stop, and it's continuing to get some legs, though, especially with the global appeal on the Western Cape too. The recent residential property price inflation report that was done by Stats SA covered 8 major municipalities across 9 provinces, and they did all residential properties purchased by private individuals. Now, again, it paints a very interesting picture for us here. Johannesburg has seen the slowest increase since 2010, with only a 71% increase in property values, where Cape Town is sitting at the highest with 141%. That's almost double than Johannesburg. National averages are sitting at about 98%. Now, if we look at commercial property, the Rural Report Q1 for 2024 shows all in all, rentals improved from COVID-19 declines. We are still, however, a little bit shy of 2% below 2019 levels, but there has been a slow increase, especially since 2022, with a return to the office and work environment. Grade A gross rentals in Q1 2024 rose by 6.5% compared to the previous 4 quarters. Cape Town commercial real estate market really has flourished over the last 18 months, growing steadily with demand now outstripping supply in most sought after areas, especially near the inner city. Investment value, buying in Cape Town now offers a far greater return on investment than national averages.
Hi, I'm Mike Walters from High Street Auctions. I'm head of business development in the business, and my role is to keep in touch with the trends that are happening in the market and to make sure we're on top of what's going on both geographically and in the various sectors that we operate in. At the moment, we are focused on 3 main sectors where we see most of the economic activity happening, and those are retail, industrial, and fuel stations in no particular order. We do find that the commercial or office sector is a little bit depressed still coming out of COVID, and the occupancies and demand are not where they should be or where they were pre-COVID-19. So we're looking at the retail sector, and we're seeing a lot of activity there. Obviously desirable from a perspective of consumers are still out in the market needing to buy food and goods, and foot traffic is high in the right retail sectors. So we're operating across the board from small neighborhood strip malls to larger shopping centers and malls, and we still have demand from our database or from our buyers who are interested in investing in this sector. From an industrial perspective, we still see activity in that market, particularly occupied industrial buildings in the main commercial industrial hubs in the 3 main sectors of South Africa, being Gauteng, Western Cape, and KwaZulu-Natal around the Pietermaritzburg, Durban area, and so continue to operate in that market where we have investors looking for particularly neat, attractive, good locations and premium sites. So we are very involved in the fuel station market, and we are constantly in contact with our clients, both buyers and sellers, who are looking to enter or grow their portfolios in the fuel station market. Still a very lucrative business, and we're active in that market. From a geographic perspective, we're seeing lots of activity happening down in the Western Cape. I'm sure you're all aware of the semigration that's been a dinner table talk for quite some time. And we have big demand happening in the Western Cape, certainly in the 3 sectors that I've just mentioned to you, but also in the residential market, both from people moving from Gauteng and other parts of the country, but also internationally. So we're keeping track of the geographic market as well. We have offices in Johannesburg as well as in the Western Cape and Durban. And we're not seeing that much demand happening in Gauteng across the board. But in the Durban area and in the KwaZulu-Natal area, although that market has had lots of challenges over the last few years with the unrests and the floods and the political scenario that was unfolding there in 2021, there are still demand for areas around the port and in Durban itself and the North Coast, Umhlanga, and those kinds of markets. We are still very active working with the listed funds on the JSE and the REITs, and talking to my point on the different sectors that we're involved in. The retail sector is one which is growing phenomenally well. Still a lot of the REITs have focused their emphasis and their funds on building those portfolios and disposing of the tail end, as we call it, which is the smaller assets that they no longer focus on. And the REITs have certainly built up their gearing ratios, on average looking at 37% loan-to-value ratio across the board, and phenomenal growth in the retail sector still happening in the South African market. 2024 has been an interesting year for us, with the elections that took place earlier in the year and the negotiations around the Government of National Unity and the coalition between the ANC and the DA. And talk around town is very positive, and we're relieved to be out of that political uncertainty. Next thing on the cards is going to be the Reserve Bank sitting for their meeting, and hopefully we'll look to reduce the interest rates further, maybe a basis point or more before the end of the year. Looking at the formal property market in terms of the listed funds and the REITs that we work with, in South Africa they own about 25% of the institutional or commercial properties listed. Elsewhere in the world, this number is fairly lower, 5 to 10%. So we see that the REITs have been given large amounts of funds to be able to invest in the market. But slowly over time, we do see this number reducing, and we forecast a lot of work and disposals still coming out of the formal sector. We have seen a recent uptick in the region of 20% growth in the share price of the REITs. So they are becoming a flavour of the month again. And certainly from a retail perspective, that subsector is doing extremely well. We are very excited about the prospects of the South African market. We believe that all the pieces of the puzzle are falling into place, and the year is going to end on a high with the trigger of the interest rate lowering that we anticipate, and look forward to a very prosperous future in the property sector.
Hi, my name is Marius Miller, and I'm passionate about retail and shopping centres. I particularly love convenience shopping centres. And let me tell you why I do. Retail shopping centres and the retail market in particular is successful when consumer spending is up. And we're going into a period now where interest rates will be going down, which means inflation has been curbed and is also on its way down. What does that mean? It means that people are able to spend more, that their moods are buoyed, and that they feel more confident in spending. And where are they likely to be spending their money? I believe it's in convenience shopping centres and community-based shopping centres. That part of the market is really a platform that's very similar to online, or what online is to the big shopping centres and to the big retailers, because it brings an element of convenience to the shopper. It brings an element of convenience to the retailer as well. We see that coming through in last mile logistics, where we see that space being filled up with product that is available to the retailer because they need it, because there's a demand from their shopper. And they're able to meet that demand quite quickly, and they're able to satisfy the need of their client. And that's one of the reasons that I like that market as well, because there's a responsiveness to the need of the shopper and the client. And because they are able to respond so quickly, you find the support coming through from the community in that regard. Convenience shopping centres are particularly great investments because of the types of tenants that they have. The types of tenants that occupy the space within convenience and community centres are not the nationals that we're accustomed to seeing. But to me, that's of secondary importance in terms of the brand name. The fact that the tenant has been there for a long time is more important than anything else, because it says to me that the tenants are able to trade through difficult conditions. And the reason they're able to do that is because they understand the needs of the community that they service. I would encourage those in family offices and high net worth individuals to look at retail shopping centers, particularly in the convenience and community sector, as a robust and resilient investment class. This is the space that's suited for them, that's suited for you. The banks are very supportive of that type of investor because they know that you have the ability to look after the investment, you have the ability to add value to the investment and enhance the returns into the future.
My name is Tema Matebula. I'm an associate director at the High Street Auction Company. I would want to discuss the urban revitalization, some of the global trends adopted in South Africa. The first one is the mixed-use development, which allows for the integration of the residential, commercial, and recreational facilities within the same area. The benefits of mixed-use development is to promote land use efficiency, promote local economic development, and to reduce commuting. The next model is the adaptive reuse. These models seek to repurpose old and underutilized buildings, such as factories, offices, and warehouses, into modern and residential spaces. The benefit of this model is to reduce the environmental impact and to preserve the historic architecture. The next model is the transit-orientated development. These models seek to develop residential and commercial properties within the transport hub. This model allows residents to live, work, and play in the same area. Secondly, it also allows residents to reduce driving time to work. The third one being that it also reduces the area's carbon footprint. The next model is the green and blue infrastructure development. The benefits incorporate parks, green roofs, water management systems, and other eco-friendly benefits. Research shows that urban revitalization projects can significantly enhance property values within the surrounding areas.